Hey everyone, my name is Adam. I'm the editor-in-chief of The Fifth Person, and in this video we're going to talk about how you can save just $11 a day and how that can actually make you become a millionaire. Now, if you think there's a lot of hype, I'm going to show you the steps behind how you can actually do that and use a bit of math to prove it to you as well, and how this is actually very possible for almost anyone out there. So if you're ready to learn more, let's get going. Alright, so just a little bit about us if you don't know who we are. We're The Fifth Person, an award-winning investment site that focuses on stock investing in US and Asia. So if you go to our website at fifthperson.com, you'll find tons of free articles and analysis that will help you make more profitable and better investment decisions for yourself. So this is just a photo of myself with the CEO of the Singapore Exchange receiving that award for being the best independent investment website in Singapore. So just a close-up screenshot. Alright, so back to our topic, which is about how you can save $11 a day and how that can make you a millionaire. Alright, so how is this possible? If you're having questions about this and you're wondering whether this is all BS and whether this is actually going to work, we're going to show the math behind this and why this is actually very possible for anyone. So the fact is, all of us will earn $1 million in our lifetimes. This is almost nearly a fact. Alright, so if you take a look at the median gross monthly income in Singapore, as of 2019, this figure is 4,563. So if you take that median income and you multiply that by 12, over just 20 years, you will earn $1 million in your lifetime. So some people might make more than the median, some might make less. I don't think anyone's going to work 20 years. I think a lot of us are going to work at least 30, 40 years in our lifetimes, in our careers. So I think it's almost a given that all of us will at least make $1 million in our lifetimes. But the question is, how do we hold on to it? All right. So when we talk about investing, there's so many ways we can invest, right? We can talk about passive investing, dividend investing, growth, value. And as you grow up the chain and you invest in more complicated styles and all that to boost your returns and all that, a lot of times when we get carried away with how much we can make in stock investing, we kind of forget the first step, which is we have to save. If we don't save, we can't invest. So if you don't have any money to invest, all of this stuff that you learn about dividend investing, value investing and all of that just doesn't make sense anymore because you can't invest. So it's almost like firing a gun without any bullets is not going to work, right? So in this video, we're going to talk about how much should you save to reach your goals. Can you invest with limited capital? Do you need a huge sum of capital before you start investing? And how long before it takes for you to reach $1 million? So we're going to answer all these questions in this video. So the first concept we want to talk about is that you want to save $11 a day. Why $11? I think it's very possible for a lot of people. It works out to about $330 a month, about $4,015 a year. And it's an easy number to remember, right? $11 a day. Okay, so if you save $11 a day and you save it for 40 years, so let's assume that you're going to work from 25 all the way to your 65. That's about 40 years of your career, and you're going to save $11 a day. How much would that be? At the end of your 40 years, you're going to have $160,600. So that's a far cry from $1 million. It's just saving $11 a day isn't going to get you there. All right, and I would think that $160,000 isn't a lot. So you could be wondering right now, so what's the trick? How do I actually save $11 a day and then get to 1 million? So the thing is, you don't just want to save your money. You want to put your money somewhere where you can grow it. So one place that you can actually save your money or grow your money is through fixed deposits or time deposits. In Singapore, you can put your money with any of the big banks like DBS, and they would offer you a rate to put your money with them in a fixed deposit. So if you take a look at that table, this is the latest table that I have as of today when I'm doing this video. The highest interest rate that they have right now, if you're going to put a fixed deposit with DBS, is 1.3% per annum. Alright, that's the highest one you have there. So let's just assume that it's going to be constant for the purpose of this study. Alright, so let's just say that you save $11 a day, alright, and you invest it in a fixed deposit at 1.3% per annum. After 40 years, how much are you going to get? So you're going to get $208,904. So it's still a far away from $1 million. All right, but start to look at this. You're starting to earn some interest, and your money is starting to work for you. But at 1.3% per annum, it's not going to get you to $1 million, all right? So what else can we invest in? So what about bonds? In Singapore, you can invest in something called the Singapore Savings Bond. It's safe, it's long-term, it's flexible. So compared to fixed deposits, the great thing about them is that there's no penalty if you decide to withdraw your investment, unlike a fixed deposit. And they still give you very competitive interest rates as well. So if you take a look at the current interest rate for the Singapore Savings Bond, it actually looks really, really pathetic, all right? So you see, take a look at it right now, it's only at 0.8% after 10 years per annum, all right, compounded growth rate. So this is really low. And the reason for this right now is because, as you know, COVID-19 has really just decimated economies everywhere. Interest rates are being cut to boost economic growth. So that's why you see bond and the interest rate, they're just coming down at this point. But this is not a typical figure for the Singapore Savings Bond. So if you take a look at the Singapore Savings Bond in February, before everything just went haywire, the interest rate at that point was about 1.75%. And this is actually kind of like the long-term historical interest rate that the Singapore Savings Bond actually has. So if I'm going to use this figure of 1.75% and then use this for our study, how much are we going to get at the end of 40 years, all right? So if you invest in the Singapore Savings Bond at 1.75% per annum over 40 years, you're going to get $229,795. So once again, you're only $250,000, not even $250,000 there. So it's still a long way from making $1 million. All right. So this, if you're going to work and put it in a bond, like the Singapore Savings Bond, it's not going to get you to your goal. So what can we invest in then? The next asset class you could consider is gold, right? Gold is something that a lot of people talk about, and it's something that, people like to say it holds on to its value. Now, the reason I don't really like gold is because it's not a productive asset. So a productive asset is something like land or, a business or property or even cash. So the reason why these are productive assets is because they generate economic activity. So if you put money in the bank, it generates interest. If you buy a piece of land or you buy real estate and you rent that out, you generate more income. If you invest in a business through a stock, that business provides economic activity and it generates profits, and that generates interest, I guess, as well. It gives you dividends. So those are productive assets. But for gold, it kind of just sits there. It doesn't do anything. A lump of gold is going to be a lump of gold 20 years down the road. And the only way that you can profit off of gold is that someone's going to buy that off you at a higher price. All right. So gold, art, or even tulips, if you remember tulip mania in the Netherlands hundreds of years ago, all these are non-productive assets. They don't really add anything. They don't really drive economic growth. All right. So that's what gold is. It's a non-productive asset. Okay, so that's my opinion on gold. Some people, they might like gold as an investment. I don't really like it. I would think it's a hedging instrument, more or less. But let's just say you want to invest in gold. All right, so what is your return if you invest in gold? So this is a chart of the price of gold from 1990 all the way till today. 30 years ago, the price of gold per ounce was $398 US. And as of now, the price of gold is at $1,932. And recently you can see the spike is going all the way up is because right now we're in the midst of a crisis. And in the midst of a crisis, a lot of people just kind of rush to gold as a safe haven. So you see this spike in gold prices right now. But, let's just take this as the price of gold. And what is the return per annum if you analyze this for gold? Okay, and if you do the calculations, it is actually 6.52% per annum. So the question is again, if you save $11 a day, which is about $4,000 a year, right? And you invest in gold and you assume it's going to grow at 6.52% per annum over 40 years, how much would you have at the end of it? If you do your math and you calculate this out, you would have $708,763 at the end of 40 years. So we're getting much closer to our goal. But then again, we're not even close to $1 million. So what about stocks? If you invest in stocks, how much would your returns be? Now, one way to invest in the stock market, the simplest way is actually to invest in something called an index. All right, so what is an index? So an index is essentially kind of like a basket of stocks. You have all your stocks, stock A, B, C, D, and E, you put it all together into a basket, and that's a stock index. And if you invest in an index, you kind of like, you don't have to pick stocks anymore. You don't have to decide which stock is better than the other. You don't do all this fancy analysis that we have to do when you want to analyze stocks, and that can get pretty complicated. And you say you just want to just buy the entire market. So you kind of like average out your returns just by buying the stock index. In Singapore, we have a stock index called the Straits Times Index, and it comprises the 30 largest companies in Singapore. So you see some very familiar names if you're Singaporean, right? So like DBS Bank, Hong Kong Land, OCBC Bank, UOB, SGX, Keppel, and CapitaLand. All the REITs are there as well. So these are all household names in Singapore, and they comprise the Straits Times Index. But the thing is, it's not all equal, okay? Some stocks are bigger than the others, and you have to weigh them accordingly within the index. So within the STI, the top 10 stocks, which you see up there, DBS, OCBC, and so on, they comprise about 77% of the entire STI, with the rest coming in at 33%. So if you want to invest in the STI and you want to mimic how the STI grows, you're going to have to invest in 30 different companies at their exact weights to mimic the STI. And if you were to do it all by yourself, I would say it's going to take you a lot of time. You got to monitor 30 stocks, you got to monitor the prices, you got to balance your portfolio, and it's going to get really, really complicated. All right, so not something that I would recommend. So the question is, how then do you buy the entire index? You can do that by buying an ETF. ETFs, which stands for Exchange Traded Funds, that actually buy the entire index for you. So you don't have to buy 30 stocks all by yourself. You can just buy one ETF and you do all that rebalancing and all the purchases and sales all for you just to mimic the index. So in Singapore, we have something called the STI ETF. And what is the long-term historical return for the STI ETF? So if you take a look at the data, since its inception in 2002, the STI ETF has returned 5.59%. This doesn't look really good right now because, we're in the middle of a COVID-19 crisis, so stocks have been beaten down. They haven't really fully recovered. But we're going to take that figure anyway and use 5.59%, and just going to find out what you're going to have at the end of 40 years if you save $11 a day and you invest in the STI ETF. Alright, so if you do the math, you will end up with $560,000 at the end of 40 years. So again, not near enough your goal of making $1 million by the time you retire. And this is even less than investing in gold. But then again, whether it's going to be gold or the STI, it seems that saving $11 a day is still not going to get you to $1 million. Now, what about investing in the US? So Singapore is a really small country. It's a small economy, but the US is a different monster altogether. All right, it's a huge country. It has over 330 million people. They all speak the same language. They share the same culture. They spend the same dollar. And, it's home to some of the most innovative companies in the world like Apple, Google, Microsoft, Facebook. And these companies are the best in the world at what they do. Alright, so if you want to invest, you probably want to have a look at the US. So if you want to invest in the US, ETF or index would you be looking at? What they have in the US is called S&P 500 ETF. So the S&P 500 comprises 500 of the best US companies, and these are the best companies around anywhere in the world. And you can see many famous names right here like Apple, Microsoft, Alphabet, Amazon, Visa, ExxonMobil, Disney. These are names that anywhere in the world you would recognize, not just in America, right? You will recognize these companies anywhere in the world. So again, if you want to invest in the S&P 500 all by yourself, investing in 500 different stocks at the exact weights, that's going to drive you crazy. So you don't want to do something like that. So all you got to do is to invest in the S&P 500 ETF. And the S&P 500 ETF is called the SPDR. And the long-term return of the S&P 500 ETF since its inception in 1993 is 9.44% per annum on average. Again, let's do the math. If you invest $11 a day and you invested in the S&P 500 for 40 years and 9.44% per annum, and the answer is $1.5 million. So there you have it. At the end of 40 years, you have made $1 million and more. So you've reached your goal, and it's possible. I've shown this to you that if you save $11 a day and you just invest in the S&P $500, you get to the end of 4 years, this is what you're going to have. And take a look at the breakdown over that you see here. The entirety of this amount, 89%, was due to your money working for you. Interest, earning more interest, and just your money growing and compounding for you. So let's just summarize everything in one single table, saving $11 a day. All the historical returns are there, and these are the amounts that you would have after 40 years. And you can see that investing in the stock market, especially in the US, will get you to $1 million or more after 40 years, all right? If you want to take a look at the years to hit $1 million investing in the other different asset classes, I don't think anyone has the time to save $11 to hit $1 million. It's going to take you more than 2.5 lifetimes or more than 3 lifetimes to get there, all right? And the only possible one, most likely going to be the stock market, all right? And this is the fastest way for you to get to $1 million in 35 years or less. And this is just saving $11 a day. If you save more, if you earn more, you can save more. If you save $20 a day or $30 a day, you'll get to your goal a lot quicker, and you will have a lot more after 40 years. So if you haven't even started saving, this is probably time for you to consider doing so. Now, I want to raise some very important considerations when you're going to do this, all right? And some people might not be aware of them, so I want to point them out to you. So number one, you must be really disciplined. It's not like a 3-month weight loss plan and then you ditch it. It's something that you have to be so consistent at it. You're going to do this for 40 years. You got to save money, you got to invest it, you got to be patient, and you must keep a long-term perspective, and then you will reach your goal. And point number 4 is probably one of the most important things, is because the stock market doesn't go up in a straight line. It's going to go up, it's going to come down, and recently, as you witnessed, during COVID-19, it has crashed 30% in a month or so. So you have to remember that even though the S&P 500 has grown at 9.44% per annum, on average, it doesn't do that every single year. Some years it does better, some years it doesn't do so well, like this year, all right? So remember, it doesn't go up in a straight line. You'll see there are many ups and downs along the way, all right? You'll see different crises during different eras, different years. So you have the post-Korean War recession, you have, the Nixon recession, the oil crisis, Black Monday, the dot-com bubble, the global financial crisis, the China-US trade war, and then recently, of course, the COVID-19 crash. Every single time, there's always a crisis that causes the market to crash. But if you take a really long-term view, as a whole, the market rises over the long term. And it rises because of inflation, because of population growth, because the index always comprises the best companies in the particular market that it tracks. So in the case of the S&P 500, it's always the best 500 companies. So as a whole, the index always rises over the long term. So before I end this video, I just want to point out or share a story with you about this person called Ronald Reed. You may or may not have heard of him, but I think it's something that he's going to be an inspiration to many of us watching this, all right? So Ronald Reed was just basically a janitor. He lived from 1921 to 2014, and he was just, a janitor. But when he passed away, he left behind $8 million and gave it away to charity. My question is, how did he do it? And he basically invested in stocks, in blue chip stocks, and he did it for almost his entire life. Because he was able to save and invest for a really long time, by the time he passed away, he was able to give away $8 million. And if someone like Ronald Reed, a simple janitor, could do it, anyone, almost anyone, can do it as well. And that includes you and me. So if there's one thing I want to end this with you, is that if you haven't started doing so, just start saving today. Alright, I hope you liked this video, and if you enjoyed it or you learned something new today, feel free to like or share this video with your friends and family, or add a comment in the comment below, and we'd love to have a conversation with you. And if you want to learn more about how you can start investing in high quality value growth stocks out there for your own portfolio, you can go to thequadrantstrategy.com, and we have more free video content for you. You can check it out at thequadrantstrategy.com, and we really want to see you there. And once again, thank you so much for watching this video, and we'll see you around.